Raising capital for your startup is not easy. In fact, it is one of the most challenging things you can do in business. In general, most startups fail to raise investment capital because they fail to understand what investors are looking for and what makes a business worth investing in. Raising capital post-COVID-19 is going to be even more difficult. More businesses than ever are going to require external funding, yet access to capital will be limited. This does not mean startups can't raise capital at all, as investors who have capital will still be looking for great opportunities to invest in. Just the way founders approach a funding round will need to be more diligent and dedicated. In this video, we are going to explain everything there is to know about raising capital for your startup post-COVID-19 and how to increase your chances of getting funded. Before we get started, we'd like to ask you a question. Do you think raising investment capital is essential for a startup? Or should founders protect their equity by self-funding? Let us know your thoughts in the comments. Let's get started. 1. What stage are you at? There are 3 main stages of a business looking to raise capital: idea stage, proof of concept stage, and growth stage. Idea stage. Nolan Bushnell once said, "Anyone who's ever taken a shower has had an idea for a business. It's the person who does something about it that makes a difference." Ideas are a dime a dozen, and investors do not invest in ideas. If you believe in your idea and believe it has potential, you should work on it, even if it's small steps every day. We're not saying quit your day job and sell your house, but you can work a few hours a week to turn your idea into something tangible without investing too much time or money. This does not mean investors don't invest at idea stage at all. However, to raise investment at idea stage, investors are expecting you to have a deep understanding of your business, your product, your market, your competition, expertise in the industry, and a great team to execute on the plan. You should be able to articulate why investing at this stage is a great opportunity for investors, not why you need money to experiment on an idea. Investors are only interested in maximizing their returns. They are speculating on you and your ability to return as much profit as possible. Proof of concept stage. If you are at this stage, it means you have managed to build the foundations of your business and are proving the viability of the concept. Investors like to invest at this stage, as it shows you have taken the leap and backed your belief by taking some risk. It is also early enough that they can speculate on a decent return if the company does well. At this stage, you are trying to prove that the concept is viable, even if you are working with low metrics to begin with. You don't need to have a lot of sales, you just have to prove the concept works and can be scaled. Investors should be able to look at these metrics and project what will happen if you were to scale by X amount, at an X% growth rate, and how their investment will help you get there. Growth stage. Growth stage funding usually comes after a few rounds of seed funding have been made. Typically, growth stage funding will be known as a Series A or Series B round. This is a more complex funding round, as you will be raising between $1 and $5 million. In order to reach for this level of funding, you should be able to meet the following criteria. You have proven the concept beyond a few metrics and are able to demonstrate there is huge scalability with this business. You have proven there is an appetite for your business in the market, and you can foresee long-term growth over the next 5 to 10 years. You are generating significant revenue. You have proven that you are solving a problem which affects many people. You are able to protect your IP in some way so that it is not easy to replicate. You and your team have the right knowledge and expertise to scale this business exponentially. You can prove there is an exit strategy in place so investors can realize their returns within 5 years. You can prove this business is relevant in the post-COVID-19 world. This round of funding usually takes 3 to 4 years into the life of a startup, so you have enough time to prove the concept. 2. The business. Before seeking investment and before asking someone to invest their hard-earned money into your business, you should ask yourself the following questions. Does this business require external funding? Have I done everything I can myself before seeking investment? Is this a good investment for an investor? Or am I experimenting on someone else's dime? Will the funds raised accelerate the growth rate of the business? Do I have anything unique that can't be easily replicated? Is the valuation fair and realistic? Asking yourself these questions will allow you to see the opportunity from the investor's point of view. If it doesn't seem fair to you, it won't seem fair to them. 3. The team. Having a great team is one of the biggest deciding factors for investors. Many institutional investors now offer investments to strong teams of people before an idea for a business has even been thought of. If you are a solo founder, you will really struggle to get an investment. So if you are a tech guy, you should find yourself a business guy. If you are a marketing expert, find yourself a tech expert. Ideally, you want to have 2 to 3 founders as part of the team, including yourself. Research shows business with a solo founder have a much higher fail rate than businesses with 2 founders or more. For this reason, investors like play it safe and back what has worked in the past. Also, investors are not particularly keen on a team of people who are employees of the company. They prefer to have 2 or 3 founders who have significant ownership of the business, rather than 1 founder and 5 employees. 4. Company deck. Having a company deck allows investors to see all relevant information within a contained document. A good company deck should contain the following information: company and contact details, a brief summary of the business, explanation of the market and opportunity, details of your competitors, how you're different and why you will exceed them, information regarding the metrics of the business, a clear exit strategy, forecast predictions, and information regarding the team members. You can create a great company deck on the Gunga platform. Go to gunga.com, click on Create Listing, fill out the details. Once completed, you will have a professional-looking company deck which you can share with potential investors who can make you a direct offer. 5. Valuation. Valuation is one of the biggest reasons a deal does not go through. Founders put a lot of value on their time, effort, and sweat equity. Investors, on the other hand, do not care about any of that. Investors put more value on their money and believe their money holds more weight in this scenario. It is important for this reason to set a realistic valuation that works for both sides. 6. Types of investors. Not all investors are the same. They don't all have the same investment criteria or investment goals. Before seeking investment, you should establish which type of investor you would like to partner with. We have categorized some investor types. Low-level, passive. This is someone who would likely invest alongside a syndicate or through crowdfunding. This type of investor is not looking to run the business with you or be involved. They will invest and wait for an exit. Mid-level, active. This is someone who is looking to join a team and be an active member of the business. This type of investor is someone who may have $50,000 to $100,000 in savings and wants to leave their day job in pursuit of a more challenging and rewarding venture. High-level, passive. High-level investors tend not to be very active in the running of the business. They are likely to have busy lives, but have capital to deploy while you do the work. They will likely invest and wait for an exit event. Philanthropist. Not all investors are investing purely for financial reasons. Some investors invest because the business or idea resonates with them, or it is something they are passionate about. There are many investors who invest in minority-only or women-only businesses to increase diversity within entrepreneurship. 7. Build a relationship with investors. Investors receive many pitches on a daily basis. They don't have time to respond to everyone. Before you pitch to investors, get to know them and build a relationship with them. Get their feedback and opinions on certain aspects of the business before you ask them to invest. This process can take time, but it's worth it in the long run. 8. Network with other entrepreneurs. You never know who you might meet and who will be able to help you somewhere along the way. It's always great to network with and bounce ideas off other like-minded people who are going through the same journey as you. Networking with other entrepreneurs allows you to see the entrepreneurship from a different perspective. The Gunga platform allows entrepreneurs to connect with each other for free. Take advantage of this platform and start connecting with other entrepreneurs instantly and build your network in the startup ecosystem. Before we go, remember to answer our question in the comments. Do you think raising investment capital is essential for a startup, or should founders protect their equity by self-funding? Let us know your thoughts in the comments.